How do we know if we're in a bubble? Do you think we're there yet? Does this feel euphoric?
I mean, I don't think necessarily that we are in a bubble looking at broad equity markets. I mean, yes, we're certainly seeing this narrow breadth, this concentration within the Magnificent Seven. Valuations are stretched there. But from an earnings perspective, Q4 earnings, they were, able to beat or, meet those elevated expectations. Looking further out, these are the companies that are going to be profitable. The key question is, are we going to see this kind of expansion of that gains across different sectors? And I think we've yet to see that. And that's really kind of the key catalyst that I would watch for, to have greater conviction that this is a rally that can be sustained.
OK, let's come at it from another angle. At some point, we are going to see the market taking a dip. Now, we don't know how long that dip is going to last. We don't know what magnitude it's going to look like. But at some point, very few things go in a straight line for very long in markets. So at some point, we're going to get a correction. You get a correction. When do you know when to buy the dip? Is that correction going to be pulling in a lot of money out of money market accounts? How do I play a dip when it comes?
Well, I don't think it's quite clear that we're going to see a significant drawdown from here. I mean, what's the catalyst for that? It's really hard to see that given the economic backdrop. And if we kind of take a step back and look at the earnings picture, if we look at some of those cyclical sectors in the U.S., in Q3 and Q4 of 2024, those expectations are actually set to outpace what we're seeing from tech. So we could actually just see this broad rotation beneath the surface within overall U.S. equities, rather than kind of this catalyst that could prompt this sharp drawdown.
What's the catalyst then for Europe? And do you want to? At what point do you want to think about upping your exposure to Europe if you haven't done already? What would the key points be for that? It's a market that is not performing on the earnings front. It's not matching, obviously, what we're seeing in the US or indeed Japan.
And this is a great question. I think we certainly are warming up to European equities. If we look at a lot of those forward-looking leading gauges, it does suggest that economic activity has troughed. We are continuing to see this disinflationary trend persist. The ECB is poised to cut rates by June of this year. The key thing that we're watching for is negotiated wages at the end of April, just to signify that they are actually seeing that easing in wages. We're already starting to see that play out in equity markets. Certainly those cyclical sectors like industrials, consumer discretionary led the rally in February, whereas defensives were a bit on the back foot. Probably a bit too premature to kind of go all in on those cyclical exposures. And we're still looking really for that quality tilt. Because if we think about what's kind of the supports in European equities, it's healthcare, it's looking at what we're seeing in luxury, and as well as semiconductors. So quality captures about a third of those different stocks. So that's the way we want to play.